Welcome to today's webinar called the UK Retail Update. My name is Charlotte and I work in the customer success team at GlobalData. For those of you who aren't familiar with GlobalData, we're one of the world's leading data and analytics providers, and our mission is to help our clients decode the future to be innovative and more successful. Our speakers today will be Sophie Wilmore, who is an Associate Director in Retail, and Patrick O'Brien, who is the Retail Research Director. So before we begin, everyone is on mute, and the session is recorded, so you will receive an email with the recording and slide deck in a few days' time. And now, without further ado, I'm going to pass over to Sophie and Patrick.
Thank you, Charlotte. Hi, everyone, and welcome to our UK Retail Update webinar. Firstly, I'll be showing you our latest consumer confidence data, how shoppers are feeling about their prospects in 2026, and the implications on consumers of the changing macroeconomic landscape. And then I'm going to hand over to my colleague Sophie, who will share with you our very latest sector forecast and also showcase a few hot topic reports that we have coming out. We really appreciate you taking the time to join us today. We intend to be done within the 30-minute time slot. Please put any questions in the chat and we'll answer you directly offline afterwards. Okay, so to consumer sentiment. Let's have a look at how consumers are feeling. This is our Future Sentiment Index, which is calculated by averaging out the three main measures of confidence, namely economic outlook, personal finances, and future retail spending prospects. Now, in the last webinar in January, we asked you all in a poll whether you thought sentiment would improve or get worse by the end of Q1. We showed you the chart here, and sentiment had started heading upwards after a poor few months at the end of 2025. And you were almost completely split on whether sentiment would increase or decrease. 47% said increase, 53% said it would decrease. But, well, it got better for a couple of months, but then, of course, Trump intervened and it got a whole lot worse. In fact, March's fall was the biggest month-on-month drop since the first COVID lockdown, and the only larger drop other than that before COVID was 10 years ago after the Brexit referendum. So there is a lot of fear out there caused directly by the Middle East crisis. But is it going to go higher or lower in the next few months? So we'd like to ask your thoughts once again. We're going to be doing our next webinar at the end of Q2. So we're just going to open a poll and ask whether you think that consumer confidence will increase or decrease between now and June. Charlotte, could you please open the poll? That's great. That's up there then. Yeah. Do you think consumer confidence could increase or decrease between now and June? Please vote now and I shall share the results shortly. In terms of whose confidence is falling, this chart shows the change in confidence since last month by demographics. So it's March compared to February. And as you can see, men are losing confidence more than women. And the youngest adults are, it seems, barely bothered at all. Indeed the lower socio-economic group for the DEs. On that 18 to 24 years age group, I'm not sure if this is perhaps a lack of experience in how foreign conflicts and oil prices could affect them, but of course many of them won't be paying energy bills. Maybe they don't see the connection between the Middle East crisis and prices rising and the threat of recession. But Charlotte, do we have the results of that poll?
Yes, 35% said increase and 65% said decrease.
Okay, thanks, Charlotte. So, yeah, that's quite a strong showing for it falling further. 65-35, that's quite a big gap. Of course, it's already at a very low level, but yeah, it's hard to argue that there could be falling confidence to come. So confidence is down, but what does that mean for retail spend? Here we have adjusted retail volumes taking into account population increases and seasonality, and we plotted that against the future sentiment index shifted 3 months ahead, which is where we are seeing the greatest historical correlation between sentiment and sales, confidence being a leading indicator. It seems to indicate that sales will increase further before falling later in the quarter, but in this instance, the shock of the Iran conflict to consumer confidence may well impact retail sales more quickly, causing people to hold off whilst they see what it might mean for their personal finances. Now, I just want to quickly mention our recently released Global Consumer Sentiment Tracker dashboard, which is available on our platform, and it covers consumer sentiment in over 50 countries worldwide. The above chart shows confidence at a global level, and you can see that it dipped quite a lot in March, as you could imagine. Now, you can track a number of metrics for each country, and nearly all countries saw confidence fall in March. Except curiously in the USA, where younger generations especially do not seem particularly worried about the impact of the crisis in the Middle East, and this shows that the narrative we are experiencing is not necessarily the same narrative being experienced elsewhere. Now back to the UK. Investors have already hit retail stock prices harder than overall equity markets. The FTSE All Index is down a bit less than 10% since the crisis began, but UK-listed retailers are down by, on average, 14%, and it's mid-sized retailers that are getting hit hardest. Here we have the drop in share price on the vertical axis and plotted the retailers in order of size on the horizontal axis. Now, it is apparent that home retailers, the ones I have circled there, are being hit hardest, with grocers doing comparatively better. Investors are worried that big ticket spends and home projects will get delayed by the uncertainty being caused, and of course we are coming up to that critical spring period for home improvement. The recovery from the cost of living crisis was already weakening before the Iran conflict, and here are some of the recent media headlines. Unemployment was up, real wage growth was slowing. Already we can see the immediate direct impact on consumers in the Middle East crisis. Mortgage rate fixes are up about 0.5 percentage points already and could go higher if the Bank of England increases base rates. We've already seen fuel prices increase at the pump, and food price inflation, which had been decelerating, will start to accelerate again to almost 4% in the coming months, based on forecasts from our colleagues at TS Lombard. While this could increase much further, our forecasts are based on the crisis not significantly worsening, even if it does not resolve immediately. However, we fully appreciate that the crisis could get much worse, and a scenario where food prices increase much higher to, say, 8% is entirely possible. Energy bills won't rise until July, but are likely going to hit a 3-year high then. In short, consumers are going to have to spend more on food, fuel, mortgages and energy bills this year, more than we had previously forecast, and will therefore have less discretionary income to spend on non-essential retail. What has been a slow and fragile recovery from the cost of living crisis is threatened to be derailed. Here we have the ASDA income tracker, which we've re-indexed to take into account inflation to give a real discretionary income index. And it shows that while the spending power has been recovering since April last year, it's still around 6% less than it was before COVID. The impact of fuel, energy and food increases will see much of the gains made in the last 9 months being reversed. Now, we have seen that this shallow recovery has also been very uneven, in that only the upper income earners can really be said to have recovered. The lowest income quintile still has to find on average £71 per week to cover a shortfall on essentials, either by dipping into savings or increasing debt. Now, this chart shows how discretionary income has changed by income quintile over the last 3 years. And you can see that while the recovery was lopsided towards the upper quintiles, the increase in discretionary income that the upper 2 quintiles have achieved has slowed down considerably in the last 12 months. Lower incomes may want to play a very small violin at such news, but it has major implications for retailers, as these are most likely to spend and they will not be feeling as well off as perhaps we might think due to that slowdown in growth. Which leads us to the savings ratio, which remains high and could start to rise again due to the combination of uncertainty and interest rates now likely to stay higher for longer. We had been expecting interest rates to fall to 3.25% by the end of this year. Now it seems economists expect them to stay at 3.75 in a best case scenario, with the possibility of increases. Consumers with money will be incentivised to save ahead of splurging, and this is another aspect to the impact of the crisis. Confidence falling, essential spend increasing, saving more rewarding leads to lower non-food retail spend. And with that, I shall hand over to Sophie to show what that means for our forecasts.
Thanks very much, Pat. I'll just share my screen. Okay, hopefully everybody can see that okay. So moving on now to our latest UK retail forecast for 2026 and beyond. So as we've seen, consumer confidence has tumbled, the macroeconomic environment has become more volatile in the last month, and the economic outlook for the remainder of this year at least looks quite different to a month ago. So as a result, we have adjusted our UK retail forecast. So as Pat has mentioned, consumers' budgets are coming under pressure once again, with many people still feeling the effects of the cost of living crisis. So we do expect non-essential retail spend to be deprioritised. As a result, we anticipate the overall retail spend growth will be 2.6% in 2026, which is compared to our view in February of 2.7% growth. So this doesn't sound like too much of a change, but the breakdown of what will drive this has changed quite significantly, and I'll cover this in more detail shortly. So this chart shows UK annual retail spend growth on the line, inflation in the beige bars, and volume growth in the blue bars. The dotted line in the background shows our view of retail growth last month. So you can see that inflation will be the main contributor to growth this year, which we did expect previously, but this has become a bigger driver, with volumes now expected to be slightly lower. So retail inflation for 2026 is now forecast to be 2.2%, versus our previous view of 1.8%, and volume growth is now forecast to be 0.4% versus 0.9% previously. So we expect that higher prices across sectors owing to higher fuel costs impacting the transportation of goods and higher energy costs overall. As prices rise, shoppers will cut back where they can, leading to lower than previously anticipated volume growth this year. But overall, we do still expect to see positive volumes, which will be the first time in a number of years. The adjustments to our forecast are focused on 2026 at the moment due to the uncertainty of the length of the Iran conflict and the impact on the UK economy. But as you know, we do review our UK forecast every month, as well as our forecast for all of the countries we cover. So we will be making tweaks to 2026 and beyond as necessary, depending on how the war develops. And then just to mention, from 2027 onwards, we are forecasting growth to slow as inflation eases and total growth comes more evenly from both drivers, with volumes improving out to 2030. So looking at our latest forecast by channel, this chart shows annual growth split by channel in the lines, with online penetration shown in the blue boxes above the chart. So the blue line shows online annual growth, and the green line shows in-store or offline growth. The dotted lines in the background show our view in February. So you can see that we've brought down our 2026 forecast for both channels, but a bit more significantly for the online channel, coming down from 3.8% growth previously to 3.6% growth now. The bigger change to online is because 82% of online spend in 2026 is forecast to come from non-food sectors, and we think non-food spending is going to be hit harder by the latest changes to consumer sentiment. More on this shortly. We do still expect that the online channel will continue to outperform this year, with online spend rising 3.6%, while offline sales increased by 2.2%. Online spend is forecast to account for 28.2% of the total retail market this year, and that's 41.3% if you just look at non-food. And we expect this to slowly increase to account for 30% of retail spend by 2030, rising at a fairly consistent pace each year as the online non-food market matures. So now delving deeper into how our view of 2026 has changed by sector. As I mentioned earlier, we expect UK consumers to prioritise their spending on food and essential items this year. Shoppers will be holding off spending on non-essential products like items for their home, which can be deferred, as well as clothing products that they could go without. So on the left chart here, you can see UK food and grocery growth in the line, with inflation and volume shown in the beige and blue bars respectively. So the dotted line in the background shows that our view last month was that food growth would be 3.5% in 2026, but we've now increased our forecast to 3.7%, driven by the higher inflation expected. With tight margins on food items, we anticipate that grocers will be passing on the higher costs that they'll have to deal with, which will be due to higher energy costs, fertilizer costs and fuel costs. Consumers have already traded down to cheaper supermarkets or cheaper products at their usual grocers during the cost of living crisis, so we don't anticipate there'll be too much switching happening. We expect that grocers will continue to capture spend from food service operators as shoppers cut back on eating out and buy treat items or dine-in meal deals to create those more special dinners at home. In terms of non-food, shown on the right chart here, we've brought down our forecast with 2026 growth now set to be 1.7% versus our previous view of 2.1%. As you can see, we are forecasting some volume growth, but this will not be the case in all non-food sectors, as we'll discuss in a moment. We think retailers will need to pass on some of the higher costs, but this will be more difficult to do in non-food sectors where demand is weaker. So looking at the non-food sectors in more detail, as has been the case for around the past 3 years, we forecast that health and beauty will be the star performer in 2026, with spend rising 3.9%. This chart shows our view in February in the light blue bar on the left and our current view in the bright blue bar. So we have slightly reduced our growth expectations for health and beauty, but we still think this sector will be a priority for shoppers with volumes forecast to rise this year. The essential nature of toiletries and some beauty items will mean a chunk of this sector spend will be protected. And additionally, UK consumers are continuing to prioritise their health and well-being, viewing buying health and beauty items as investing in bettering themselves. We think there's some risk to less essential beauty categories like fragrances and makeup, where shoppers will be cutting back, but overall this sector will take less of a hit than other areas. Moving on to the non-food, the next highest growth in terms of non-food sectors for 2026, and that's electricals. So we anticipate that growth will be 2.4% this year, down from our prior view of 2.7% growth. We're seeing replacement cycles driving some spend amongst more affluent consumers, so items such as laptops bought during the pandemic are now being replaced by those who can afford it. However, this is likely to slow off throughout the year as big ticket purchases are put on hold where possible. The global memory chip shortage caused by the rising demand for AI infrastructure is impacting the production cost of certain electrical items such as games consoles, laptops, phones, and this is likely to impact the product prices, which may put some consumers off buying. Despite this, there are some categories within the electrical sector that are essential. For example, if your fridge, washing machine or oven breaks, you'd have to replace it immediately, and this will safeguard some electrical spend regardless of weaker consumer confidence. So now looking at the home sectors, the close connection between the housing market and spending on home items is part of the reason why we have brought down our forecast for the home sector this year, with combined growth now set to be 1.8% versus 2% previously. With mortgage rates increasing, there'll be fewer people likely to be buying for the first time or moving house, which normally helps to stimulate home product purchases. Coupled with this, weaker consumer confidence will lead to big home projects being deferred and larger non-essential purchases, such as the sofa, being put off. So we expect that bigger ticket categories like furniture will be harder hit, as well as the DIY sector, as home projects are put on hold. We anticipate that, as we've seen throughout the cost of living crisis, that homewares will be more resilient this year, with shoppers turning to those smaller items like cushions and throws as affordable luxuries that can make living spaces feel revitalised without having to spend too much. Finally, clothing and footwear was forecast to see the lowest growth this year, and the picture remains the same, with predicted growth now more than halved to 0.5%. As we've seen in recent years, shoppers can fairly easily hold off on clothing purchases to help save money, instead shopping from their own wardrobes or just buying the bare essentials like children's wear. We expect this to be the fourth year in a row of volume declines in clothing and footwear. The accessibility of second-hand clothing also makes it easy for shoppers to switch from buying first-hand from retailers to buying from other consumers on platforms like Vinted and eBay, saving them money while still getting an item that is brand new to them. So here we can see all the elements of the retail market on one chart. You can see total retail on the far left, denoted by the shopping bag icon, then food and non-food, denoted by the books icon, and then the non-food sectors on the right side. So to summarise what I've talked through, the major changes to our forecast are that non-food growth is set to be lower this year due to a lower forecast across all sectors, but a major drop in clothing and footwear and a minor drop in health and beauty. Food growth is expected to be higher due to higher inflation, and all of these changes combined mean that we've brought down our UK total forecast growth to 2.6% instead of 2.7% previously. So clearly 2026 is looking challenging, particularly for non-food retailers. But as we said, the extent of the Iran conflict is unknown, and if the war ends soon, consumer confidence could get back on track and the outlook for retail spending may be more positive. As always, we will be closely tracking changes and we'll be updating our forecast at the end of each month, which you can find on our market analyzer or within our UK monthly retail forecast report. Okay, so for the final section, we wanted to showcase some of our recent topical insights that we thought you might find interesting. Just to remind you, each month we run a survey of 2,000 nationally representative consumers, and most of the data collected in that survey does feed into our regular reports, like our consumer sentiment report, but we do have some space in the survey to add in questions on newer key topics that we haven't covered elsewhere. We then create short hot topics reports using this data, usually 3 reports a month, so do let us know if there's topics that you would like to see us covered in these reports in the future. So in the next few days, we'll be publishing our report on the impact of GLP-1 or weight loss drugs on users' shopping habits. We've been asking for about 6 months now whether respondents are taking GLP-1 medication, and in our survey earlier this month, we asked these respondents how their shopping habits have changed since taking the medication. So of those respondents who are taking weight loss drugs, over 65% have changed their food shopping habits. Over half said they're buying fewer snacks, and over half said they're making more of a conscious effort to buy healthy food. And it's interesting to see that given weight loss drugs suppress your appetite, over 1/3 said they are now buying less food in general. The grocers are well aware of the rise in GLP-1 usage, and we've seen lots of products coming out targeted at users. But in terms of where users are buying less, grocers will need to try and find opportunities to entice them to buy to try and maintain their volumes. For example, highlighting those specific claims like high fibre or high protein, or potentially creating smaller bite-sized snacks, for example, that might appeal more. And looking at the impact on clothing and footwear now, 61% of GLP-1 users said their clothing and footwear shopping habits have changed. Almost half said they're buying a smaller size now, potentially driving additional sales for clothing retailers. But almost the same proportion, 46.5%, said they have put their clothing purchases on hold while they're losing weight. And over 1/3 are trading down to cheaper items, as they don't expect to continue to stay that size permanently. So it's maybe likely to be aiding the growth of some of the value retailers like Shein and Primark. Items that cover a broader size range, for example, in women's wear that could be small, medium and large rather than 10, 12, 14, might be more appealing to shoppers who are in the process of losing weight. So clothing players should consider this, as well as potentially creating products that can be adjusted. For example, like you can find in children's wear where school uniforms, skirts and trousers have adjustable waistbands. So we wanted to finish on a topic that is very relevant right now as we are fast approaching Easter next weekend. So the Easter Intentions Report is part of our UK Occasion series. We have lots of reports in this series, with the main occasion report published after the event, once we've carried out a consumer survey, asking what shoppers spent, which retailers they bought from, which product areas they purchased. This is one of the intentions reports. So these are published prior to the major occasions, and they use consumer survey data that is gathered around a month before the event. So intended participation in Easter is higher once again this year at 68.5%, and this is the highest participation of any occasion after Christmas. Easter celebrations are becoming more home-focused this year, with a stronger intent to spend time with family and friends and a growing appetite for baking, while fewer shoppers plan to rely on takeaways and meals out. This signals greater demand for ingredients, shared treats and easy activity-based purchases. Novelty hot cross bun flavours, cupcake kits and small treat bags of chocolates will be popular items for shoppers to indulge in this year. And then looking at retail categories that shoppers intend to buy in the top row and have already bought in the bottom row, we can see that food and drink and gifting continue to underpin spending for Easter, but the balance has shifted a little bit this year. The standout change is a sharp uplift in planned spend on other seasonal items, such as home and garden, decorations and seasonal clothing, which really signals a broader spring refresh mindset. So we'll be publishing a spring decor report alongside our main Easter report this year, as this seems to be a growing area of opportunity for retailers, with consumers encouraged by social media to decorate their homes for the spring season, similar to what we've seen in terms of kind of autumn decor and the trend there. So here are the reports we featured today. A couple of them haven't been published yet, but will be out by the end of the month, our latest forecast report and our GLP-1 hot topic report. But the others you can find on the Intelligence Centre now. Thank you for joining us today. We hope this has all been useful. And as always, please feel free to share any feedback or further questions you might have, and we'll answer those offline. As Pat mentioned, our next webinar will be at the end of June, and I'll now hand back over to Charlotte.
Thank you so much, Sophie and Patrick, for these super insightful insights on UK retail. Thank you for your questions as well, which our team will get back to. You can also email customersuccess.retail@globaldata.com if you have any further questions, and everyone will receive the recording and the slide deck in a few days' time when that's ready. So that concludes the webinar today. Thank you all for attending. Thank you for your time, and thank you to our speakers, and hope you all have a lovely day. Bye-bye.